Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what these corporate filings are really telling us. Today we're diving into a report that might sound a bit alarming at first glance, but let's see what is really going on under the hood. We've got a current report here from Kindly MD Incorporated, and it's about a notice they received regarding their stock listing. Now before you panic, let's break down exactly what this means for the company and its investors. It seems like Kindly MD isn't quite hitting the mark on one specific stock market rule, and we're going to unpack how they plan to fix it. So what exactly happened? Kindly MD, or the company as they call themselves, got a notification from the Nasdaq stock market. Nasdaq has rules for companies whose stocks are traded on their exchange. One of these rules is about the price of a company's stock. Specifically, it says that for a stock to be listed on the Nasdaq global market, its closing bid price needs to be at least $1 per hair for a certain number of days. The problem here is that for the last 30 business days, Kindly MD's common stock, which trades under the ticker symbol NACA on the Nasdaq global market, has had a closing bid price below $1. This is a clear violation of Nasdaq listing rule 5450-1. Now, the filing is quick to point out that this notice doesn't mean their stock is immediately going to be kicked off Nasdaq. They can still trade as usual. The important part is that Nasdaq gives companies a chance to fix this. Kindly MD has a grace period of 180 calendar days, which means they have until the 8th of June 2026 to get their stock price back up. To do this, the closing bid price of their common stock needs to be $1 or more for at least 10 consecutive business days within that 180-day window. Nasdaq might even ask them to maintain that price for a bit longer, up to 20 consecutive business days, just to be sure. Now, what if they can't get the stock price up to $1 within those 180 days? The report outlines an alternative. They might be able to transfer their listing to the Nasdaq capital market. This is essentially a different tier within Nasdaq generally for smaller companies, and it has slightly less stringent requirements. To do this, they would need to apply by the end of their initial 180-day compliance period, pay a fee, and meet the other listing standards for the capital market, with an exception for the minimum bid price. They would also have to show Nasdaq that they have a plan to fix the low bid price issue, possibly through a reverse stock split. This transfer option is interesting because it shows Nasdaq is willing to work with companies facing temporary setbacks. However, it is not a guaranteed pass. They still need to meet other Nasdaq capital market requirements, like having a certain market value for their publicly traded shares, and they need to be very clear about how they'll address the low stock price problem. Nasdaq staff will review their plan, and if they don't believe the company can fix the issue, delisting will still be on the table. If despite all these efforts, Nasdaq decides to delist Kindly MD's common stock, the company still has one last resort. They can appeal the decision to a hearings panel. This is a formal process where they can present their case and try to convince the panel to let them stay listed. So what is the takeaway here? Kindly MD is facing a common problem for smaller companies maintaining a minimum stock price. They have a clear path to regain compliance, either by naturally increasing their stock value or by strategically moving to the Nasdaq capital market. The company states they will actively watch their stock price and explore options like a reverse stock split. But, and this is a big but, the report itself warns us that there are no guarantees. They might not be able to keep their stock listed on the Nasdaq global market, and even if they transfer to the capital market, there is no certainty of success there either. This highlights a key risk for investors, the potential for delisting, which can significantly impact liquidity and the perceived value of their investment. The report is signed by Terry Gendron, the Chief Financial Officer, on the 12th of December 2025. This is a standard part of these filings confirming that the company's leadership is aware of and responsible for the information presented. Now, looking at this situation more broadly, Kindly MD is in a precarious position, but it is not necessarily a death sentence. Falling below $1 is a common stumble for companies that are growing or restructuring. The key here is their strategy moving forward. A reverse stock split is a tool that can artificially boost a stock price, but it doesn't fix underlying business issues. If their business fundamentals are strong, they might succeed if not. Even a transfer or a split might just be a temporary fix. Investors should be looking closely at the company's actual business performance, not just its stock price, to assess its long-term health. What is really important is whether they can actually grow their revenue, manage their costs, and ultimately become profitable. Without that, technical maneuvers on the stock market are just window dressing. The risk here is that the market perception of a company that is struggling to maintain its listing could further depress its stock price, creating a difficult cycle. Alright, that is our breakdown of Kindly MD Incorporated's latest filing. What is your take on their situation and what they plan to do? Do you think they'll be able to regain compliance, or is this a sign of deeper issues? Drop your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives into corporate filings. Also, don't forget to check out our Discord community linked in the description for more discussions. Thanks for watching, and we'll see you next time on Corporate Decoder.